Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. Michael Bishop is with us today from Austria. And Michael, welcome.
Well, hello. I'm Austrian, but I'm here in Switzerland and I live in Switzerland.
I keep mixing that up. and so, well, I guess one of these days I'm gonna have to come visit, and then I'll. Okay, just something just fell out of bed. I just had a dive notice in my ear on one of my alerts. So let me slide down here really quickly. Anyway, can't see that. So hey, let's get going. We've got a lot to cover in a very short time frame. As many of you are probably aware, are some of the premium active trend traders. After this session is over, and we will be concluding, and the recording stops at 11:50, no later than, and we'll be pressing and going in, and then we will start up the new webinar, which you should have gotten your access code to that, and I see that several of you are signed up for that, and we will start that new webinar called The Final Hour at 12 noon, and hopefully have some setups for our strategy 3 and other strategies, but we're going to be focusing primarily on strategy 3, selling premium going into the weekend. So I'm glad you're here today, and away we go. A lot to cover in a short period of time. Want to remind everybody that all materials are presented for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. If this is your first time with us on the How to Make Money Trading Stocks webinar that we do every Friday, Michael is, as he said, in Switzerland, but he's originally from Austria. I know he does a lot of holidays during the summertime, which I don't blame him, but he is a independent investment advisor for the Swiss Wealth Management Company, and here is his disclaimer. And so, but Michael is always a welcome addition to what's going on, simply because he brings that European perspective to what is going on here in the U.S. market, and I just absolutely love that and how the two interact, because we are intertwined during these days. So I want to remind everybody that at the Active Trend Trader we focus very strongly on training. This coming Wednesday, we will be talking about planning second chance entries. We just finished almost a 3-month training session covering and helping people build the building blocks that then they can take and then trade into any type of market environment with a sound system and sound strategies. We even got into one trade this past Wednesday night. So if you were on the training webinar on Wednesday, you had the complete setup to get into GRUB, grub, and it triggered off the next morning. And so that's one of the things. And one of the things that came from that, which I was very appreciative of, I got some feedback about, one, that members really liked the concept of having that order discussed but also in place the night before it was needed, because we're scattered across many time zones. I mean, I know some of you are getting ready to go home from work on the East Coast, at least I hope you are, and it's still 8 o'clock in the morning where I am, and so because of that, I'm going to have I think it's a major tweak or a minor tweak, and because of the time difference I can appreciate here in Hawaii, I'm going to do my utmost to get out my alerts the night before. That way they will be ready for you, ready for the premium active trend traders. It will be ready for you either that night if you're a night owl, but if you're up early the next morning prior to the market opening, those will be in place for you so you can see those alerts, and then if you want to parallel trade with what I'm doing, because remember, these are no recommendations, it's just saying here's what I see, here's what I'm trading, then you will have that a little bit more time to be able to act on those items. So with that said, let's move along. So this week, big ranges, downward pressure. I basically, for both the S&P and the Nasdaq, I kind of I left blank the description, because right now, if I were to put one word into both pairs, it would be indecision. With the Russell, on the other hand, the most fearful of the expected rate hike, because the small caps tend to have have a higher level of leverage, and if the Feds, which everybody believes the Fed will raise rates at no later than December, and as we have seen over the last, at least the initial market reaction has been not a happy one, and people are basically or with all the uncertainty in the market, what could be happening also is that the, a second, let me get my, what we could be seeing is, because of the uncertainty of the U.S. elections, the uncertainty of the foreign banks, the wobbly economy, China is in the news this week, Germany is in the news this week, it sets itself up for a really, kind of a perfect storm to, hey, let's take some profits off the table. And so that's what we may be seeing that's going on this past week. I'm glad Michael was able to join us today, because Michael, we've been talking a little bit about the Deutsche Bank, but also some of the other things that are, connecting. You sent an article to me earlier this week that kind of talked about the fiasco that's going on in Great Britain now with Brexit. And so how do you see all that tying together for trading through the end of the year and maybe going into 2017? Does 2017 look bright and rosy and everything's going to be wonderful, or does it not?
Well, of course, the honest answer is I have no idea, but there are some indications. So what I see currently is that the market is very US centered. So also the weakness of the last couple of days is US centric, and Europe follows a little bit. So that's
okay.
What you can see from the charts. And what's also a big difference is that the US is now in a bull market for years,
right?
And still in an uptrend. Also, it gets the up gets lower and slower, and I think all markets in Europe, or at least the most important ones, had their highs, I think now 18, if not more, months ago.
Okay.
But they have not collapsed, and no crash, so really just going a little bit down week after week.
Okay. Here's a question.
So I think for the next, so then Deutsche Bank, I think they will kick down the can a little bit, and they can also, I think, Great Britain will, it will be a mess in the next 1 or 2 years, but I wouldn't expect any really surprising stuff before New Year, and same with Greece. So I think I would be surprised if Europe gets the catalyst for any major drawdown or uptrend.
Okay, so basically what you're just saying is kind of a meandering sideways market as things work their way out. One other thing that I found interesting that I think may cause some quick hiccups in the markets is the Great Britain's Prime Minister is pushing for a faster rather than a slower exit from Brexit, and is trying to accelerate the timetable.
Yeah, I think she is kind of forced to.
Okay.
I mean, I think it's also it's to avoid to get too soon under pressure from Europe to speed up.
Okay, and one of the questions from Joe, Michael, is actually a really good one and indicative of a trader. He says, Michael, is Deutsche Bank approaching a buy area?
I think that the perspectives are also, it would have been a wonderful trading for the last days. I think 25% from, it went up 25%.
Okay.
And I think it's pretty clear now. It's kind of a penny stock.
Okay.
And I think it will go up 20% and down 20% a couple of times maybe in the next year.
Okay.
But I think at the end it's pretty worthless, and it's all it made a day come when they restructure the whole company, and then maybe shares go to the government or whatever.
Interesting.
Yeah, but I think it's really not an investment. It's maybe you can trade it on the US market. The ticker is DB, and it's relatively liquid, so that's not a problem at all.
Okay.
But I would really keep it to a trading vehicle.
Okay. Well, over here, the Fed has a meeting coming up in about 2 weeks, first part of November. I'm characterizing that Fed meeting as being kind of like a non-event, and then it will be followed then very rapidly in a non-event, simply because I don't think the Fed's going to do anything to rattle any cages prior to the U.S. elections. The two candidates are doing enough on their own to rattle cages, and so it's been quite interesting to watch how things have been playing out. So I think the Fed's a non-player for the next few weeks. The Fed then becomes back into importance, I think, and also Mike Traeger and I were discussing this earlier, comes back as an important player at the December meeting. And remember last December when they raised rates 0.25%, the market did not react well. So we'll see what's transpiring. 2017, oftentimes the year after presidential election, tends to be, sometimes can be, kind of weak, but sometimes, depending on the economic policy of the previous president, can also be a good step-up year. And so we'll see what's going on. Hey, the percentage of stocks above their 20-day moving average for 9/30, this is where it was. Here is where it is today. It basically is pushing back down into this oversold condition, and when it gets down to this oversold condition, we start looking for our triggers for the early warning alert system, and oftentimes when we get some closes below this 30 number on the percentage of stocks above their 20 on the NYSE, then we'll start putting out standby alerts saying, hey guys, get ready, something's going to happen, we're not sure when exactly. This year's been a little bit crazy because on every one of the pullbacks into this area this year has been almost immediately followed by a reversal and a nice little rally. Even the last one that happened back in September, I think we picked up about a 10% gain on that one in a few days, trading the leveraged index ETFs. But there's been no real, solid, great entry signals on some of the earlier entries. And so, and then Mike was on vacation on one of them, so the fact of the matter is it's been a really challenging year for that. We're pleased and happy so far with that we have caught a couple of the runs, and at the same time though it's causing us to enter little pieces of the trade at as close as possible to the low, and those are the ones that can get you shaken out really quick. So here's where we're sitting as of this week. We'd like to get some more posturing down here somewhere between 30 and maybe down to 15, because that would be an indication that the market was really getting more and more oversold. On the longer term, the percentage of stocks above their 200-day moving average, as you can see, we're 2 weeks into the month, and more and more stocks on the list are dropping back below their 200-day moving average. For the longest time, after mid-2013, they dropped below 80% and have still not been able to get back up to that level. Made an effort 3 months ago, but now is starting to roll back over, and we may, we'll see what's the relevance of these kind of charts is what they basically do is they give us a picture of participation in the uptrend or participation in, what's going on in the market. Is the uptrend being held, being supported by only a few stocks, or is it a lot of stocks? And it kind of gives us a check into what's going on internally in that index, and we like to use the NYSE because it is a not non-leveraged, but it's not non-weighted, and so each of the stocks on it have an equal weight, unlike the NASDAQ or the S&P, which can somewhat give some false readings because a few stocks can hold that index up, while the rest of the index, the stocks in the index can be quite underwater. So it's that's why we watch this particular index or this particular indicator, the percentage of stocks above their 20-day moving average. You can find it at www.barchart.com. Let's get over to the charts. As we see, what took place this past week is that the Dow is back down below its all-time high. The NASDAQ, the Russell, back way down below its all-time high. The Russell for the year had gotten up over 11%, and it is now pulled back from that. As I said earlier, the Russell has the potential of having the greatest fear of rising interest rates because the small cap stocks, it'll have a bigger impact on them. One of the interesting points of reading, Michael, I read this week from Investor Business Daily, though, is that as growth stock investors, regardless if the Fed raises rates, or not, our objective is to find the growth stocks that are working the best within any particular given environment that the market provides for us. And I know the research that I've done over the last 10 years of the IBD 50 list is that regardless of the market environment, it has always provided a stable of potential candidates that have worked their way through the market and usually provide a really nice return for the year if selected properly. Find it interesting. It has beat the S&P soundly on various metrics going back, to 2006, 2007, and actually before that. It's just that I was only doing 10 years, working my way towards 10 years worth of data. So kind of interesting. Let's see what we have here. I think this is what I want. Yeah, that's fine. Let's go to the charts and see what's going on. As you can see, here's the S&P. I kept this, the fib between the high here, the low here, to see what's transpiring. I found yesterday's action really healthy in that it basically had dropped below the 100% retracement from this low to this high, but then it immediately rebounded very, very nicely and pushed its way back up. Today we get a gap up and a large ranging candle moving all the way up past the 8-day moving average and stayed just shy of this resistance at the 2150 level, and then sold off and is now residing below the 61.8 retracement, but above this old breakout level of 2134. During what's going on over here on the charts, on the weekly charts, is we pushed down, which actually pushed our TSI and our momentum on a weekly basis down, in the case of the momentum below the zero line, but it's holding the support, and so that's critical. And we'll see what happens with TSI. Oftentimes, if we are going to get a strong bounce, TSI will move down to the zero line and then either sometimes penetrate right below it and then bounce up, and same thing on the momentum. As you can see, even with in yesterday's big sell-off and then rebound, the momentum actually gets kind of stabilized, and today is moving sideways. From a daily standpoint, the TSI appears to be taking a pause and maybe starting to make a turn back up, and we'll see what transpires from that. But what's very clear from the S&P charts is two things. One, very large daily ranges that are bouncing between fairly well-defined levels of either support or resistance. Back up here in the moving average range. So, Mike, you got anything on the Michael? You have anything on the S&P?
No. Maybe we do it later. I just want to inform you about 29 minutes ago it was communicated that Salesforce is not interested in Twitter, and the stock collapsed once again.
Salesforce or Twitter?
Twitter.
Okay.
And what's it? -7%. And CRM, I don't have it here. And the other really surprising thing I cannot explain is in Thailand, the king who is seen like a saint person.
Right.
He died, and there's now a big fear that basically the whole country collapses, and what happens, there's one ETF, THD, and it's going up very, very significantly now the second day. So I have no idea.
That's interesting. So the king dies, and the Thailand ETF goes through the roof, huh?
Yeah. So maybe the bit. I mean, it's small markets, so maybe the business leader knows something the media doesn't get.
Okay. Wow. I always find that interesting in the smaller markets like that, how just rapidly they can grow. So apparently I'm having a little bit of bandwidth issue, guys. Please be with us. Bear with us. It will. Let's see what I've got going on here. Okay, let's go over here and take a look at the NASDAQ, and while we're waiting for this to, there we go. We're waiting for the chart to catch up. As what we're seeing here is, NASDAQ yesterday did a very similar type thing. It basically came down, all the indexes did more or less a similar thing. When they came down to a strong level of support and rebounded nicely. The buyers came in as to be expected. Today we get the new rebound up here, but look where it pulls up at, right there at the moving average cluster of the 8 and the 20, and hit that this morning, reverse back down, and appears like we may get some ricocheting back here in this area over the next couple of weeks. If it holds right there, that's just going to get us set up. One of the things that we mentioned last week was happening is that we saw, for the last, several months, price action moving on all the indexes within a range that then, bounced up and started operating in a new range. And so as the market has been, selling off, we're seeing that we may have, gone into a new range, but just at a newer, lower level. That is not unusual, and and may also just continue to be the the plague on this current market. But we have broken back down below the 820, but NASDAQ appears to be finishing above its 50. As we see, the 8 period over here on the weekly chart coincides approximately with the 50-day moving average, and it's moving back. We regained that today. On a negative side, though, is we had negative divergence nicely here on the TSI on a weekly basis, pointing to potential more downside, and the momentum is also still pointing down, which goes with this week's candle. And if this week's candle does stay in place and in effect, it will be a bearish engulfing of these last 1, 2, 3 weeks worth of effort. Same range as August. Yeah, Eric, you're absolutely right. Similar range, but just at a lower level. And a lot of times when the markets are indecisive is when you can, they'll do that. They'll move, like on a daily basis within a range, or every, a weekly basis within a range, but then the range will continue on for several weeks, and then it'll either step up or step down. When it steps down, that can be, a couple of different things. One, it can be the market is in a topping type of pattern, and we're expecting more downside later, or it's just moved down to a lower level and will remain there until they work off excesses, and then rally back up through it. When it rallies back up through it, then it's stepping back up. However, it can break out the bottom side of that also, and so it's and it can be quite productive trading within the range, and then utilizing the two extremes of the range as your either entry triggers for particular trades to the upside or downside, but then also as your, just outside of those ranges for your stops in case the market has made up its mind and made a decision on the way it wants to go from there. So as we see, that's what we have here. Looks like my bandwidth issue is caught back up. And here's what I was talking about with Russell. Russell came up very nicely a couple of weeks ago, made a new high. It was this was after the 913 bounce. This is where the Fed was talking, some of the Fed presidents or CEOs were talking about the need to raise rates. It drove the market down. Some of the more dovish Fed CEOs came in and talked it back up. It finally settled out, bounced back up on this rally. But then once it hit that rally, unlike the NASDAQ, it did not go on to higher highs, but it dropped into a lower range and has now dropped again back down into a range that may come down here and test the 100, but is clearly now below the 50-day moving average. And it appears, again, it appears that things are going to continue falling. However, the oversold condition is getting to extremes, and I'm not going to say that this is the support where it's going to bounce and come back up on real strongly, but it is seeking an area where the buyers can come in and be supportive. So as we see again over here, similar type thing, and the same type of issue here with the true strength indicator, the momentum, and compared to the other indexes, you can see in this section here on the TSI on a weekly basis, when it drops and the slope increases, that means the acceleration to the downside is also increasing. So Michael, that's about all I have on the indexes. Anything of note for you on this?
Well, I think currently Nasdaq is the strongest, Russell the weakest. I can say it that way. Huh?
Yes, I would.
And what I also see that the biggest kind of old economies, basically the Dow Jones companies,
Right.
that they are it's a very slow down, but it's, if you quickly go to the chart.
Of what? The Dow?
Yeah. Or the ETF would be DIA.
Yeah, what this is the Diamond ETF.
I mean, the S&P looks pretty similar, but it's now, it started July, yeah? So it's now the third month where there is not big support.
No. Yeah, so I mean, it has finally worked its way back down to where it found support previously. And let me get the hold on just a second. Excuse me.
But what you also see at the end of the day, there's almost always support. Yeah, we have two candles really.
There you go.
Okay.
Daily on the left, weekly on the right, and you know, it similarly, it found, you know, its old support was down here at the 18,000 level. It pierced through that and then popped back up, and now is struggling between, you know, resistance up here at 1840, 18,400, and down here at 1800. But as you were saying, the point you were making was this is the old and crotchety stocks.
Yeah.
Okay. Not a lot of motivation there. So, okay.
That's the point, yeah.
Gotcha.
That's the summary.
Okay. So let's move on to okay. Can everybody? Okay. Can you see the? Okay. Why is this not clicking through? There we go. So path of least resistance as we currently see it, what I'm kind of seeing, Michael, is that I'm seeing basically a sideways type of movement. You know, more and more resistance is coming into play, and less support is coming into play. But right now we're just a range-bound kind of market, and so this is what I'm not, you know, betting large in either direction until after we get past the election, and then we'll watch the charts to see where things go from there. I think people can, you know.
Yeah, I totally agree. Maybe currently the bond market is more exciting.
And so, and since I don't trade bonds, then I can just do boring stuff.
Well, I don't trade them neither, just the TLT and
yeah.
And the ZB futures.
And so I think that anybody can make a case for, like, I heard somebody, or I read somebody's article that said that the market in 2016 is going to all new time highs, and I'm going, okay, look at that with a little bit of a jaundiced eye. Where I think a major move to the downside is, I won't say more likely, but I think one can make a case for, a healthy reset, and that would be what would be really interesting, because you take right now and go from the highs of the years down 5% on the S&P. It puts you right back at a nice support level, and it puts you down where a 5% reset is oftentimes what's needed to kind of just, get rid of the foam, get rid of the froth, so that then, the better stocks can start coming to the surface again and moving up from there. So that's what I'm seeing going on there, Mike. And you're kind of in concurrence with that?
I'm sorry. Yes, I mean, I had an interesting discussion where
Can't hear you, Mike.
we had a discussion where we basically agreed. I mean, it's a pretty unique situation. I mean, you have, if you don't want to lose money, you have to go into stocks. There is no alternative right now.
That's right.
Especially then also, I mean, in Switzerland, you can also, I think, now forget the real estate market. It's just, it's in a bubble.
Okay.
And also not affordable for the mid-class people now in the bigger regions.
That's very interesting.
And a big difference is also that people that put now new money into stocks put it there not to lose a lot and not to make the big to make a fortune in a quick time. So I would say if the market goes down, let's say months after months a little bit,
yeah,
then the pain level is quite big. So
okay.
People just keep watching.
Okay.
But on the other side, if we have kind of a crash or the downturn happens rapidly, then a lot of things could happen, and then there could be panic.
Yeah, well, that's an interesting perspective, and it's good to know also there in Europe that there is, a housing bubble, because that's happening in various areas around the United States, as the guys online know, those especially like in the Bay Area, the coastal areas like in New York and all that kind of stuff. We know how high the cost of living is there. Not all the country has participated in that, but the bubbles are insane. Having just sold a house in California, I just shake my head and go, this is nuts. And Mike Traeger, this is for you, buddy. Long term, this is where Mike Traeger is sitting for right now, primarily because that's his long-term outlook, primarily because of the length of time this current bull market has been in place, and what's currently propping up the bull market, which is primarily stock buybacks by the companies, reinvesting. I won't even say reinvesting themselves; they're just buying back, and then also the foreign central banks that are also coming in and putting money in it. But you talk about the one of the things you said, Michael, that just caught my attention is the people who are investing currently in the European market or any stock market are, kind of, I won't say newer, but that would make sense because the newbies tend to get into the market towards the end of cycles, and their personal pain thresholds, they don't want to risk a lot. And if things start sliding a little bit, I can see them being very quick on the trigger to try to get out, which then you get a cascade of selling going on. And we know that this week institutional traders are taking profits off the table. And oftentimes they're the ones who are, are most aware and are in planning. And so if they're taking profits off the table, it's a good thing to not be, real heavily invested. And so let's move along. Okay, this week got bit on the Juno trade, but then also made a good quick 10% on a nugget trade. We also have a grub trade open for strategy 1, 0 trades open for strategy 2, and then strategy 3 has done pretty well for us this week. We continue to close the gap between our expected equity curve, which would give us about a 40% return for the year, and every month we have to close this gap back up. Last month we made a nice push back up towards that equity curve, about $2,300 away from it right now between current pace for the month and what left has to be done, the remainder of what has to be done. I'm not going to go into the Juno trade. This is one we did a couple of weeks ago, and the strategy 3 system strategy continues to work well. We continue to sell premium against 2 positions that we hold long in Tesla. This is the first half of the position that we closed out earlier, and in a month, in a year's worth of time, we basically, between the residual value and the long leaps that we had, a call and a put, and what we had collected in premium since September of last year, we basically more than paid for the cost of the position, which is about $9,000. Then on top of that, we added another $9,018 for a gain over. And that's not a promise that this is what's going to happen, but this is the way that this strategy was designed. We're looking for somewhere between 50 to 100% of what we have invested to gain back what we've invested, plus another 50 to 100%. And then we're working 3 entities in that right now, the Spiders, the Tesla, and Nugget. So coming up in the month of November, monthly BAM meeting in San Jose at the San Jose Masonic. This month we have a very special guest, Lee Tanner. Some of you may be familiar with Lee. Will be in attendance, and he's going to be talking about how to develop a rock solid watch list, and he's also going to give you a synopsis of how his portfolio is done for the year in his process. He is a pure IBD trader, and so and does a remarkable job every year. Training says, hey, second chance entries is coming Wednesday night on our training sessions, and unfortunately I got sick when we first got back to Hawaii, and also my cat almost died. So he was in the emergency hospital for 4 days, and but we're both recovering nicely now. But these are some of the videos that I'm going to be working on separately to get out to the premium members. So with that, just a reminder that with the active trend trading system, we focus on the 5 pillars of active trend trading: what to trade, top quality IBD growth stocks and or index ETFs, or special ETFs for seasonality, such as the Nugget or the GLD like we're trading right now. When to enter, when to exit, what strategy to use, and what to expect. So with that, just a reminder, oftentimes we will focus on strategies, but they don't have a sound system underneath them. Mike Traeger and I worked on the active trend trading system over almost a 10-year period of time, just cherry picking what we thought were the best features from some of the other trend trading systems out there, and we just pulled it together based on and used technical analysis to finalize the finishing touches. And then what we've done is we basically have focused, take the active trend trading system and let it trigger for us in 3 strategies: stocks and index ETFs, buying them long or selling them short. 70% of our capital is tied up here. 10% doing basic option strategies, and somewhere between 20 to 25% in the wealth and income, which is generating weekly income. So with that, I want to say see you guys next week. Michael, thanks for joining us, and have an absolutely great weekend.
Thank you.
Okay, and if you are registered for the final hour, I'm going to close down this webinar and let the computer reset itself, and then we'll be back in about 10 minutes on the other webinar. So thanks for joining us, guys. As always, a true privilege. Have a wonderful weekend, and God bless everybody.
Okay, goodbye, everybody.